Good afternoon to everyone who's joined us, and I can see we've got a few more people joining as we go through. So welcome to our webinar today on effective risk management in OCIO. So speaking here is Frank Szymanek, Senior Consultant with Plan Pilot. We're a firm that specializes in doing OCIO searches and due diligence oversight. And I personally have a great deal of experience having been an OCIO provider, as well as now being the specialist for leading these services. Joining me today, we're very pleased to have Vijay with TIAA's Endowment and the Philanthropic Services Group. And Vijay, maybe a quick introduction of yourself.
Yeah, thank you, Frank. This is Vijay Tunikipati, Chief Risk Officer of TIAA Endowments and Philanthropic Services. My role at TIAA Endowments is to work with our clients and investment team to monitor and manage risks in our client portfolio. And today I'm excited to talk about risk measures in endowment portfolio management. Thank you, Frank.
Great, Vijay, thanks for joining us. And so we've got a few slides here and some prepared comments. We would also welcome any questions that you may have. And in your control bar, you should see a row that's labeled questions, and you would be able to input something there. And we'll try to tackle as many of those as we can as we go through. Everyone should be on mute, so unable to speak on our session, but using the question function would allow you to communicate with us. So with that background, let me go through an introduction here of the goals of today's sessions. So a lot's being discussed, of course, about the state of the economy and the market. We're about 10 years since our last recession and market downturn. So there's this growing concern that perhaps we're due for some riskiness in the market. So we want to focus today on what that might mean in terms of what risk is, the most traditional way of looking at it, and some alternative ways of looking at it that might be effective in anticipation of a possible downturn. So those would be the goals of today's session. In a second session, we've got planned looking at some of the practical implications of that, how you might incorporate more of a risk budget concept into your investment policy, into your asset allocation, and into your spending policy. So today we'll focus on more on the definitions and the concepts, and then in the next session we'll talk about the application of those. So with that, we'd like to start out maybe just doing some level setting. Vijay, if you would help us out, help us understand kind of the basic concept of what risk would mean in an endowment or foundation portfolio.
Yes, Frank. The main role of an endowment is to support the mission of the university. To fulfill this role, an endowment determines its short-term and long-term objectives. At a very high level, we can define risk as any event that adversely impacts an endowment's objectives and therefore its ability to support the mission of the university. The two main objectives of an endowment are, one, to preserve and grow the purchasing power or intergenerational equity, and two, to support the spending policy and any portfolio funding commitments. Now, this dual mandate can be impacted in many ways, as the endowment is subject to portfolio management decisions and the vagaries of the market. I will give a few examples of such risks to an endowment portfolio. So the next page, this chart on this page shows three hypothetical paths of how an endowment value may evolve over a long period. The dotted gray line shows the inflation-adjusted growth of the endowment. For the endowment to preserve its purchasing power, its value after removing any spending dollars should be equal to or greater than the value indicated by this dotted gray line. The tan-colored line illustrates two types of events that reduce the endowment value. The endowment may suffer a permanent loss of capital due to an idiosyncratic risk in one of its investments, either due to a bad investment decision by the investment manager or due to a fraud. The endowment could also suffer deeper and longer drawdown than the market and or its peers. The path represented by the green line shows the endowment loses intergenerational equity, possibly due to poor asset allocation decisions or poor manager selection. The evolution of the endowment value shown by the blue line is quite volatile, and this volatility of endowment value impacts the stability and predictability of the spending dollars and may cause problems for the university's capital planning. These are just a few examples of events that can adversely impact the endowment objectives and therefore its ability to support the university's mission. All these events are examples of risk to an endowment.
Great. Thanks, Vijay, for the overview. And so obviously we start to see here there are different ways of looking at risk, and yet most institutions really focus on the primary measure, a standard of volatility. So could you talk a little bit more about what that standard measure accomplishes and perhaps what some of the weaknesses to that would be?
Yes. A very common way and intuitive way to think about risk is the variability of returns and also the relationship between returns of various investments. And a popular measure of the variability of returns is volatility. There are different types of volatilities, and I will mention two that are relevant to endowment portfolio management. The first one is historical volatility. This is something that we can observe and measure based on past price movements of an investment or portfolio. Historical volatility is quite commonly used in portfolio management activities and for reporting risk. The second type is future or forecasted volatility. Future volatilities of asset classes are important component of capital market assumptions used by endowments, and especially in their asset allocation process. The volatility metric can be calculated or estimated in different ways. Historical volatility is calculated as the standard deviation of returns and is usually expressed in annual terms. Two important parameters in the calculation of standard deviation are frequency of returns and the time period for which we are calculating volatility. For example, we can calculate volatility of an investment as a standard deviation over a period of 10 years using monthly returns. Volatility or standard deviation is a simple and convenient measure of risk. It is easy to understand and easy to calculate. Investors generally assume higher volatility means greater risk. However, this commonly used metrics has some shortcomings, and I will mention two of those. The first shortcoming is that volatility is non-directional. So this metric is not concerned about the direction of price movements, and it includes both bad or negative returns and good or positive returns. Increased variability of returns is a bad thing only if the chance of losses increases. The second shortcoming is that volatility can underestimate actual risk. The calculation of volatility makes two big assumptions. First, the returns are normally distributed, and second, that correlations are stable. Neither is true. We know and have historically observed that distributions of investment returns of equity markets and especially of some hedge fund strategies are asymmetric and have fat tails. In other words, they are non-normal. For this reason, volatility measured as a standard deviation of returns does not accurately quantify the actual risk in a portfolio. And in fact, it generally underestimates tail risk, which refers to low probability extreme negative outcomes. It may give an indication of how much of a roller coaster ride to expect along the way, but gives little or no indication if you will arrive safely at your destination within the given time scale. And it tells you nothing about the chances of an accident on the way. In summary, while volatility is a simple and convenient measure of risk, it is not a perfect measure and therefore should be used cautiously.
Great. Thanks for the explanation there and some of the shortcomings of the most traditional measure, a standard deviation measure that we see in investment policies. So again, anticipating the possibility of a downturn and the potential of drawdowns and downside risks, can you give us some explanation of what some of the other measures that institutions should be thinking about and incorporating and planning for?
Yes. There are different ways of measuring risk other than volatility. These additional risk metrics provide different and more accurate ways of quantifying risk as they highlight different aspects of actual risks in a portfolio. So on this page 7, we list some broad categories of these risk metrics. They are measures of variability of returns, measures of relationship of returns, measures of diversification of returns, and exposures. And today I'll focus on the first category, the measures of variability of returns. So on the next page, page 8, we give a little more details on some of the downside risk measures. So measures like downside volatility, value at risk or VAR, conditional VAR, and maximum drawdown all improve over volatility by addressing one or more of its shortcomings. These metrics generally focus on negative outcomes or downside risk. Downside volatility, also called downside deviation, is a quick fix to volatility. It is calculated in the same way as volatility, except that it considers only bad or negative returns. However, this metric still suffers from other limitations of volatility. For example, like volatility, this metric is not accurate when return distributions are not normal. The value at risk or VAR metric goes one step ahead of downside volatility, as it caters to return distributions that are not normal. So it is an improvement over downside volatility. The VAR metric gives three types of information about a potential loss: the magnitude of loss, the probability of loss, and the time period of loss. An example of a VAR metric is 5% probability that the loss in the portfolio will exceed $1 million over a period of 1 month. However, the value at risk metric has several limitations. Conditional value at risk, or CVAR, tries to overcome some of these limitations. CVAR is calculated as the weighted average of extreme losses in the left tail of a return distribution and is therefore gives more information than value at risk about potential low probability extreme losses in a portfolio. In other words, conditional VAR is more sensitive than value at risk to the shape of the left tail of a return distribution. One common and positive feature of the three metrics, downside volatility, value at risk, and conditional VAR, is the asymmetric nature of the measurement. That is, only the bad outcomes or negative returns are considered. Another common but negative feature is that these metrics do not consider another important type of risk, which is the sequence of negative returns. Now, this brings us to the next metric, the drawdown risk. Maximum drawdown represents the worst loss suffered by a portfolio from its previous highest point and is caused by consecutive negative returns. This metric is useful, especially as capital preservation is a key concern for endowments. The drawdown metric quantifies a multi-period risk and is dependent on the sequence of returns. In the event of a large market drawdown, metrics like volatility, VAR, and conditional VAR become less useful. There are many aspects of the drawdown metric that help us understand the risk profile of a portfolio or investment. They are the magnitude of drawdown, the duration of the drawdown period, the duration of the recovery period, and how these compare with those of peer portfolios or benchmarks. In summary, these additional measures of downside risk can be used in various portfolio management activities, and they help endowments understand and manage the various aspects of the actual risk in the portfolio. And these metrics are an improvement over volatility by varying degrees.
Great. Thanks, Vijay, for introducing us to those other metrics. Just a reminder to our audience, again, if you'd like to ask a question, you can drop one into the drop-down box. But as we move on, Vijay, how do we start thinking about these in terms of quantifying them and then planning for them with some anticipation that some of these events could happen here in the next year?
Sure. So on page 9, the next page, so we will be able to quantify risk with a comprehensive and robust risk framework. A good risk framework would be able to quantify a wide array of risks using various models. For example, on this page, we see an example of a risk framework that TIAA Endowment employs. The blue boxes on this schematic represent the various types of risk analysis available to the TIAA risk framework. Each analysis is below each analysis, we list the different types of metrics measured and the risk models and tools used. It is important for the endowment staff to understand the benefits and limitations of various risk metrics and the assumptions underlying the risk models being used. This understanding will help the endowments use the risk analysis in an appropriate manner. The next page, this picture shows why we need to look at risk in multiple different ways. There is no one single risk measure that will accurately convey the risk profile of a portfolio. And last and not the least, a consistent process to discuss the risk profile will facilitate making sound portfolio management decisions.
Great, thanks. So let's spend the next few minutes of our time together here asking some or answering some specific questions as they come in. And let me kick off with one here. Going back to the maximum drawdown, because that obviously connects with our audience. Can you give us a bit more of an example of what that would look like in reality?
Yes. Can we go back to page 8, please, where we described the maximum drawdown? So as I mentioned earlier, the maximum drawdown metric distinguishes between good volatility that we observed, for example, in the late 1990s, and bad volatility that we observed, for example, in the fall of 2008. The maximum drawdown metric is a multi-period risk metric that is dependent on the sequence of returns, unlike the other risk metrics such as volatility, downside volatility, value at risk, and conditional VAR. Endowments seeking to minimize volatility risk in their portfolios may not have fared well during some of the recent bull markets, including the mid to late 1990s, 2013, and 2017. And to the contrary, endowment portfolios with a focus on drawdown risk may be in a better position to take advantage of the loss buffering gains offered by those markets. There are different ways of looking at potential drawdown outcomes for an endowment portfolio. One method is to go back and assess how individual investments or portfolio combinations behaved during pivotal historical events. For example, evaluating how today's portfolio may have performed in the 2008 financial crisis can give a good measure of how the portfolio might react in a similar situation. And an endowment that plans around manageable drawdown prospects may be in a better shape to weather potential market downturns. Having a reasonable awareness of how much downturn there is in the portfolio may enable the endowment to remain calm during turbulent times and not sell investments at the very time the market may be getting near a bottom. Implementing an investment and risk framework that includes drawdown measuring capabilities is not an easy task, but such a framework has a potential to be more effective from a risk management perspective and advantageous from an investment performance perspective.
Great, thanks. Let me pull up another one here. So given what we've shared, right, that most institutions are probably looking at standard deviation or a volatility measure, and you're introducing some different concepts, how might we go about effectively introducing these concepts to an investment committee or senior leadership where we're not already having this conversation?
Right. So, there are some, key elements to an effective risk management function. And, some of them are positive risk culture, a comprehensive and nimble risk framework, well-documented policies and procedures, and an effective governance structure. First, I believe that a positive risk culture is a prerequisite for effective risk management. Senior leadership should promote and reward a risk culture that encourages transparent and honest discussions about risks in the portfolio. So if you move to to page 9, which is a risk framework, the second element is a comprehensive risk framework. A good risk framework would comprehensively cover a broad spectrum of risks, whether qualitative or quantitative, and allow assessment and quantification of these risks in a timely fashion. So it goes without saying that the leadership needs to invest in building out a good risk framework. And it is also important for the endowment staff and leadership to understand the benefits and limitations of various risk metrics. And as I mentioned before, this understanding will help the endowment to use risk analysis in an appropriate manner. This risk framework should be supported by effective governance and well-documented policies and procedures. From a governance perspective, the risk function should be well-defined with clear roles and responsibilities. An effective governance structure would allow appropriate forums for discussion of portfolio risks and for escalation of risk issues to senior leadership, for example, risk committees and/or investment committees. The process for risk assessment, discussions, escalation, and risk mediation should be well documented along with clear and specific risk and portfolio management guidelines. These will ensure that the endowment has consistent investment and risk management processes in both normal and crisis situations. So all these 4 elements that we talked about, the positive risk culture, comprehensive, nimble risk framework, well-documented policies and procedures, and an effective governance structure put together will help the endowment to interpret and blend qualitative and quantitative risk assessments and facilitate value-adding decision-making. This will help the endowment to lay the foundation for an effective risk management process.
Great, thank you again. And let me, I've got one more here for you. So you've introduced at least 3 different concepts for us to look at. Are there some others? Do we stop there, or where else might we go?
Yeah, that is a good question, Frank. And I think if you look at, once again, this page, the page 9, which is the risk framework, you will see that we have listed a lot of analysis here and a lot of metrics below that an endowment portfolio can use. And I'll pick one that I think is, pretty simple but also very useful, and that is the concept of beta. Right? Beta is a simple metric that quantifies the risk of an investment or portfolio, relative to a benchmark or market. This metric combines correlation and volatility information of the relevant investment and benchmark. In other words, beta is a measure of systematic risk in an investment or portfolio that arises from exposure to general market movements. There are many applications of beta in an endowment portfolio management. One common application is the calculation of equity beta. Using a single factor regression analysis, we can estimate an equity beta of a portfolio. It measures the level of equity risk in an endowment portfolio relative to an equity market. This metric is very useful to compare various investments or various portfolios, as equity risk is the most dominant risk in an endowment portfolio. The second application of beta, if you can move to page 18, please, is to understand the skill of an investment manager. Using multi-factor regression analysis of an investment, we can estimate or decompose how a manager decompose the manager returns into the beta component and the alpha component. The beta component is beta returns are due to the market exposure, and alpha returns are due to manager skill. So this analysis provides two insights: the various market exposures in an investment and the level and persistence of value add by the manager skills. So on this graph, you'll see that the green line represents rolling alpha. So at each point in time, we do a multi-factor analysis, and we determine the exposure to, for example, the blue line is the market exposure, and the red line represents exposure to the Farmer French small minus big factor. So this is also a very useful analysis to see how the alpha of the manager or the skill of the manager is changing over time.
Great, thanks again. And that would appear to be the last question we have here. So we'll conclude here with just a final couple comments that we are recording this session. We'll make that available. We do have a next session planned in 2 weeks from today to talk more about the practical implementations of moving forward with some of these concepts, again, in terms of investment policy, asset allocation, spending policy impacts, and so forth. So we'll get more hands-on with, again, the practical implications of doing that. You also see there our contact information. If anyone would like to have some conversation outside of these sessions, you're certainly welcome to contact either of us or our colleagues at Plan Pilot and at TIAA. So with that, we'll conclude our session for today, and thank everyone who was able to join us.
Thank you.